So do you think you can get rich off dividends? Well, we're about to find out. In this video, I'll actually compare value investing against dividend investing and see what those numbers look like over 10, 20, and 30 years. All right, let's dive in. So we're about to dive into an Excel sheet, and if you're interested, you can go to Tykr.com. And if you go to the education tab, go down to downloads. If you go to that page, you can actually download this Excel sheet and kind of play with it on your own. But let's go ahead and dive in. Now, if you're listening to this on the Top Stocks podcast, I'll explain the line so you don't have to be looking at my screen. So what we have here are two categories. We have value investing and dividend investing, and I'll kind of break this down line by line. So with the salary, what we're doing here is we're setting it at $50,000. The average salary in the US in 2023 was, I think, just over $50,000. So we'll just use a nice round number. And this will be used for both value investing and dividend investing. Then for both, we're going to say we're going to invest 10% of our income, which would be $5,000 for the year. And then our starting amount would be $5,000. That's how much we'll put into our brokerage account. And then what we're doing here is we're taking Adobe. This stock I chose because its annual return over the last 5 years was about 15%. Again, in Tykr, we try to aim for between 15 and 50%. So we're going to use the minimum. We're just going to play this conservative and say, hey, we're looking for 15% returns per year. And then with the dividend stock, I actually picked an ETF called FDL, which is First Trust Morningstar. The reason I picked this one, it actually has a really high dividend yield. It has a 5% yield, which is quite impressive. There are a lot of stocks out there that can pay like less than 1%, sometimes between 1 and 2 if you're lucky, but 5%, that's great. So we're going on the high end of the spectrum in this case, just to see how this stacks up against a value stock. So let's take this line by line on the return. So with Adobe, the last 5 years, the annual returns have been about 15%. Over 10 years, it's been closer to 24%. And over 20 years, it's been closer to 18%. So in this case, I'm going to play it really conservative. We're just going to put 15%. Then with this FDL, this index fund, get this, over 5 years, the returns on this have been 2%. Not good. The 10-year returns have been closer to 5%, which is, I always tell people, if you're going to invest in index funds, ETFs or mutual funds, go for or set your expectations. You're probably going to make between 6 and 8%. The reason is it's a bundled product. You can have hundreds and up to 1,000 stocks in one portfolio. It's not there to build your wealth. It's there to protect your wealth. But anyway, in this case, we're using this index fund as a mechanism to build our wealth with dividends, not with returns. So going back here, we're at 2% for the 5 years. Over 10 years, 5%. And then over 20 years, it's at 2% again. So again, returns aren't great, but it's really that yield we're focusing on. So down below, what I've done here is I put our return, average return we're looking at with Adobe is 15%. And I'm actually going to skew this a little higher with the FDL. Let's just say 5%, not 2%, but 5% is what we expect to earn per year. Okay, now let's compare the two over 10 years. So Adobe, at a 15% return over 10 years, your portfolio will be $121,000. And with FDL, with a 5% return and a 5% dividend yield, your portfolio will be about $92,000. So a little bit of a difference, but not a major difference. But things really change when you get to the 20-year mark. Check this out. Okay, with Adobe, over 20 years at a 15% return per year, we're looking at close to $600,000. It's actually $594,000. And with this FDL, with the dividends, again, we're taking every dividend payment, reinvesting back into your portfolio. It's a 5% return and a dividend yield of 5%. Your portfolio is $320,000. Again, Adobe is $594,000. This FDL is $320,000. So the compound interest method, the value investing method, is almost double over 20 years. Okay, now let's look at 30 years. Over 30 years at a 15% return, your portfolio will be $2.5 million. Now with FDL, looking at the 5% return and your dividend yield of 5%, your portfolio will be $909,000. Significant difference here between value investing and dividend investing. Now let's play with these numbers a little bit up top. I want to just go to that salary. Let's say your salary is $75,000. And then let's say you're investing 15% of your income. And now let's look at the numbers. So at 15% return per year with your value investing strategy, your portfolio will be $248,000. With dividend investing, it will be $192,000. So still pretty good, but things really change at that 20-year mark. At 20 years, 15% return is $1.2 million. And with FDL, with index funds, with dividend investing at about a 5% return, you're looking at $677,000. So you're about double with value investing. All right, let's jump down to the 30-year mark. 30 years at 15% return, you're looking at $5.2 million. And with dividend investing over 30 years, you're looking at $1.9 million. So well over double with value investing. So just to summarize here, value investing is for building your wealth. You look at what Warren Buffett, Charlie Munger, a lot of other investors have done through the years. They have built their wealth not through dividend investing, it's through value investing. It's compound interest. That's where you really build your wealth. With dividend investing, the strategy there is not to build your wealth. Here's what you should do. When you get closer to financial independence or retirement, what you want to try to do is move those stocks, those value stocks, over to dividend stocks. And in some cases, a value stock does pay a dividend. For example, Microsoft, a stock I hold, plan on holding for pretty much my entire life. It's great for building my wealth, but it also pays a dividend. And what I'll do is I will then keep my portfolio as is and not sell shares. So take a close look at these numbers here. Let's say you built up a portfolio of $1.9 million. Your dividend payments are about, again, it varies per stock and of course the dividend yields, but at $1.9 million, you can be paying yourself dividend payments of about $96,000 a year. Now, 30 years from now, $96,000 probably won't be a whole lot, but it gives you an idea that you can use that money to buy food, to travel, invest in hobbies, and you don't have to sell shares. That's the key, is you move to financial independence or retirement and you don't have to sell your shares. You can just pay yourself the dividends to enjoy life. So that's the purpose of dividend investing. Again, it's not there to build your wealth. It's really to just pay yourself when you hit financial independence or retirement. If you like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to learn more about investing or even find some great dividend stocks, we invite you to join Tykr for free. All right, we'll see you in the next video. Bye for now.